You know, I've been investing for over 70 years now, and in all that time, I've watched thousands of people, smart people, educated people, well-meaning people, make the same mistakes over and over again. These aren't complicated mistakes. They're not about missing some obscure financial strategy or failing to understand complex derivatives. No, these are simple, fundamental mistakes that beginners make because nobody taught them better. And these mistakes, they're expensive, really expensive. We're talking about hundreds of thousands of dollars in lost wealth over a lifetime, sometimes millions, all because of basic errors that could have been avoided with a little knowledge. So today, I want to walk you through the 8 most common investing mistakes beginners make. More importantly, I'm going to tell you exactly how to avoid them, because once you know these mistakes and how to avoid them, you're already ahead of 90% of investors. Let's start with the first mistake, and this is probably the most expensive one. Beginners wait too long to start investing. They think they need to know more, have more money, be more prepared. And while they're waiting, they're losing the most valuable thing they have: time. I see this constantly. Someone in their 20s says, "I'll start investing when I'm 30. Then 30 comes and they say, "I'll start when I make more money." Then 40 comes and they say, "I'll start after I pay off this debt." And suddenly they're 50 with nothing saved. Here's what they don't understand. The money you invest in your 20s is worth exponentially more than money you invest in your 40s or 50s. Not because the returns are different, but because it has so much more time to compound. Let me give you the math. If you invest $5,000 a year starting at age 25 and you get a 10% annual return, by age 65 you'll have about $2.4 million. But if you wait until 35 to start investing that same $5,000 a year, you'll only have about $900,000 by 65. You've lost $1.5 million by waiting 10 years. 10 years! That's the cost of this mistake, and it's the most expensive mistake on this list because you can never get those years back. You can fix every other mistake I'm going to talk about, but you can't fix lost time. So how do you avoid this mistake? Simple. Start today, right now, this moment. Don't wait until you know more. Don't wait until you have more money. Don't wait until conditions are perfect. Just start. Even if you can only invest $50 a month, even if you don't understand everything, even if the market seems scary, just open a brokerage account, buy an S&P 500 index fund, and start. You'll learn as you go. You'll increase your investments as you earn more. But the key is starting now and giving compound interest as much time as possible to work. I started investing when I was 11 years old. I didn't know everything. I made mistakes, but I started. And that early start is a big reason I'm sitting here today as one of the richest people in the world. So that's mistake number 1, waiting too long to start. Avoid it by starting immediately, regardless of how much you know or how much you have. The second common mistake beginners make, and this one's painful to watch, is trying to pick individual stocks without doing any research or analysis. They hear about a hot stock from a friend, or they see something on social media, or they read an article about some company that's doing well, and they just buy it. No research, no analysis, no understanding of what they're buying. That's not investing, that's gambling, and it's a guaranteed way to lose money over time. I've spent my entire career analyzing companies before I invest in them. I read annual reports cover to cover. I study their financials. I understand their competitive advantages. I calculate what they're worth. I only buy when the price offers a margin of safety. That's investing. That's how you make money consistently, not by following tips or hunches or what's popular. But beginners don't do this. They buy Tesla because everyone's talking about it. They buy GameStop because it's trending. They buy whatever CNBC is hyping that day, and then they wonder why they lose money. Here's the brutal truth. If you haven't read the company's annual report, if you don't understand what they do and how they make money, if you can't explain why the stock is a good value at its current price, you shouldn't buy it. Period. No exceptions. I don't care how hot the stock is or how much it's gone up or how many people are buying it. If you haven't done your homework, don't invest. So how do you avoid this mistake? 2 ways. First, only invest in what you understand. If you don't understand technology companies, don't buy tech stocks. If you don't understand biotech, stay away. Stick to businesses you can comprehend. Second, if you don't want to analyze individual companies, and most people shouldn't because it's hard work and takes expertise, just buy index funds. An S&P 500 index fund gives you ownership in 500 companies. You're instantly diversified. No stock picking required. That's what I recommend for most people. Don't try to pick individual stocks unless you're willing to put in the work to analyze them properly. Just buy index funds and move on with your life. That's mistake number 2, buying stocks without research. Avoid it by only investing in what you understand or by using index funds. The third mistake beginners make is trying to time the market. They try to buy at the bottom and sell at the top. They think they can predict what the market will do next, and they fail every single time. Let me be very clear about this. Nobody can consistently time the market. Nobody. Not me, not the smartest investors on Wall Street, not the computers with all their algorithms. Nobody. The market is unpredictable in the short term. You might get lucky once or twice, but over time, trying to time the market will cost you massive amounts of money. Here's what typically happens. The market goes up and beginners think, I should wait for a dip to buy. So they wait, and the market keeps going up, and they miss out on gains. Then finally there's a crash, and they panic and sell everything, or they're too scared to buy, so they miss the bottom and the recovery. They end up buying high and selling low, the exact opposite of what they should do. I've never tried to time the market, not once in 70 years. When I have money to invest and I find something I like at a good price, I buy it. I don't care if the market just went up or might go down tomorrow. I just buy good businesses at fair prices and hold them. That's the strategy. Time in the market beats timing the market. Every single study proves this. People who just invest consistently and hold for decades do better than people trying to be clever about when to buy and sell. So how do you avoid this mistake? Stop trying to predict the future. Stop watching the market every day. Stop trying to buy at the perfect time. Just invest consistently, same amount every month, regardless of what the market is doing. This is called dollar cost averaging. Some months you'll buy when prices are high, some months you'll buy when prices are low. Over time it averages out, and you'll do far better than if you tried to time it. That's mistake number 3, trying to time the market. Avoid it by investing consistently regardless of market conditions. The fourth mistake beginners make is panicking and selling during market crashes. This ties into the previous mistake, but it's important enough to address separately. Every few years, the market crashes. It drops 20, 30, sometimes 50%. It's scary. The news is terrible. Everyone's predicting doom, and beginners panic. They sell everything to, quote, protect their money. But here's what they don't understand. Market crashes are temporary. They always have been. The market has crashed dozens of times in history, and every single time it has recovered and gone on to new highs. Every single time, without exception. So when you panic and sell during a crash, you're locking in losses. You're turning a temporary paper loss into a permanent real loss. And then what happens? The market recovers, and you're sitting in cash having missed the recovery. So you not only lost money by selling, you also missed the gains from the rebound. You got hit twice. I've lived through more crashes than I can count. The crash of 1973-74, Black Monday in 1987, the dot-com bust, the financial crisis in 2008, the COVID crash in 2020, and many more. You know what I did during every single one? I stayed calm. I held my positions, and in most cases, I bought more. Because crashes create opportunities. Stocks go on sale. Great businesses become cheap. That's when you should be buying, not selling. When everyone else is panicking and selling, you should be greedy. When everyone else is greedy and buying, you should be cautious. So how do you avoid the mistake of panic selling? First, understand that volatility is normal. Accept that your portfolio will go down sometimes. Expect it. Prepare for it mentally. It's not a problem. It's just the market being the market. Second, don't look at your portfolio every day, especially during crashes. If you're investing for the long term, 20, 30 years, daily fluctuations don't matter. Looking at them just stresses you out and tempts you to make bad decisions. Third, remind yourself of history. The market has always recovered. Always. There's no reason to think this time is different. Stay calm. Hold your positions. Trust the process. That's mistake number 4. Panic selling during crashes. Avoid it by expecting volatility, not watching daily, and trusting historical patterns. The fifth mistake beginners make is not diversifying properly. They put too much money in one stock or one sector, and when that stock or sector crashes, they lose everything. I've seen this so many times. Someone works at a tech company. They get stock options. They pour all their savings into that one stock because they know the company. And then something goes wrong. Competition, bad management, whatever, and the stock crashes. They lose their job and their savings at the same time, all because they weren't diversified. All their eggs were in one basket, and the basket broke. Diversification is the only free lunch in investing. It reduces your risk without reducing your expected returns. You're protecting yourself against catastrophe without sacrificing gains. Now, I've been more concentrated than most investors. I've often had large positions in just a few companies, but that's because I've spent my entire life analyzing businesses. I've had the expertise and time to do deep research. For most people, that's not realistic. If you have a job and a life outside of investing, you can't spend 40 hours a week analyzing companies, so you need more diversification to protect yourself. How much diversification? At minimum, you should own at least 10 to 15 different stocks across different sectors. Better yet, own an index fund that gives you hundreds of stocks automatically. Don't put more than 10% of your portfolio in any single stock. Don't put more than 25% in any single sector. Spread it around. Protect yourself. And definitely don't load up on your employer's stock. I know it feels safe because you know the company, but you're already dependent on that company for your income. Don't make your investments dependent on them too. So how do you avoid this mistake? Simple. Diversify. Own multiple stocks across multiple sectors. Or better yet, own index funds that do the diversification for you automatically. That's mistake number 5. Not diversifying. Avoid it by spreading your investments across many holdings. The 6th mistake beginners make is paying too much in fees. They don't realize how much fees cost over time, and those fees destroy wealth more effectively than almost anything else. Let me explain how insidious fees are. Let's say you invest $100,000 and it grows at 8% annually for 30 years. With no fees, you'd end up with about $1,006,000. But let's say you're paying 1% in fees every year. That doesn't sound like much, right? Just 1%. But over 30 years, that 1% fee costs you about $237,000. You end up with only $769,000 instead of $1 million. 1% in fees costs you a quarter of your wealth. That's insane. And many mutual funds charge more than 1%. Some charge 2% or more when you include all the hidden fees. And for what? Most actively managed funds don't even beat the market. They charge high fees and deliver average or below average returns. You're paying more for worse results. I've said this for decades. For most investors, low-cost index funds are the best choice. They charge almost nothing, maybe 0.03 or 0.04%, and they match the market's performance because they are the market. Why pay 1 or 2% for active management that usually underperforms when you can pay almost nothing for passive indexing that matches the market? So how do you avoid this mistake? First, know what you're paying in fees. Look at the expense ratio of any fund you own. If it's over 0.5%, you're probably paying too much. Second, favor low-cost index funds over actively managed funds. The math is simple. Lower fees mean more money staying in your pocket, more money compounding for you instead of the fund manager. Third, avoid financial advisors who charge high fees or take commissions on what they sell you. If you need advice, use a fee-only advisor who charges by the hour, not a percentage of your assets. That's mistake number 6, paying too much in fees. Avoid it by using low-cost index funds and being aware of all costs. The 7th mistake beginners make is chasing past performance. They look at what did well last year and buy it, assuming it will keep doing well. But that's not how investing works. Past performance doesn't predict future results. Just because a stock or fund went up 50% last year doesn't mean it will go up again this year. In fact, it might crash. This is one of the most common mistakes I see. Someone looks at last year's top performing funds. They see one that's up 100%. They think, I need to buy that. So they invest heavily. And then what happens? That fund crashes back to earth. All the easy gains have been made. All the excitement is over. The fund goes sideways or down, and they lose money. Meanwhile, the funds that did poorly last year, the ones they avoided, those might be the ones that do well this year. Because markets are cyclical. What's hot becomes cold. What's cold becomes hot. I never invest based on recent performance. Never. I invest based on value, based on what a business is worth versus what it's trading for. Sometimes that means buying things that have done poorly recently because they're now undervalued. So how do you avoid this mistake? Stop looking at past performance when making investment decisions. Don't chase last year's winners. Don't avoid last year's losers. Instead, focus on fundamentals. Is the investment a good value? Does it make sense at the current price? That's what matters, not what it did last year or last month. And if you're using index funds, which you should be, past performance is completely irrelevant anyway. An S&P 500 index fund is an S&P 500 index fund. Just pick the one with the lowest fees. That's mistake number 7, chasing past performance. Avoid it by focusing on current value, not past returns. And now, the 8th and final mistake beginners make, and this might be the most important one. They don't have an investment plan. They invest randomly, emotionally, without any strategy or discipline. They buy when they feel optimistic. They sell when they feel scared. They chase whatever's trending. They have no rules, no system, no plan. They're just reacting to emotions and headlines. That's a guaranteed way to lose money, because emotions are the enemy of good investing. Fear and greed will destroy you if you let them drive your decisions. What you need is a plan, a written investment plan that you follow regardless of emotions or market conditions. This plan should answer several questions. What are you investing for? Retirement? A house? Your kids' education? Knowing your goal helps you determine your timeline and risk tolerance. How much will you invest regularly? Set an amount, $500 a month, $1,000 a month, whatever, and commit to investing that amount consistently. What will you invest in? For most people, the answer should be low-cost index funds, maybe 70% in a total stock market fund, 20% in international stocks, 10% in bonds. Something simple and diversified. When will you rebalance? Once a year, check your portfolio. If it's drifted from your target allocation, rebalance back to your original plan. This forces you to sell high and buy low. Under what conditions will you sell? This is crucial. You need to define ahead of time what would make you sell, not I'm scared or it went down, actual reasons. Maybe the company's fundamentals changed. Maybe you need the money for your goal. Having a plan protects you from yourself. When the market crashes and you're scared, you look at your plan. Your plan says to keep investing, so you do, even though you're scared. That's discipline. When a stock you own doubles and you're tempted to sell and take profits, you look at your plan. Your plan says to hold for 20 years, so you hold, even though you're excited. That's discipline. I've followed the same basic investment philosophy for 70 years. Buy great businesses at fair prices, hold them for the long term. Don't trade frequently. Stay disciplined. That's my plan, and I stick to it no matter what. So how do you avoid this mistake? Create a written investment plan. Answer those 5 questions I mentioned. Write it down. Put it somewhere you'll see it, and follow it religiously. Your plan will protect you from making emotional decisions. It will keep you disciplined when everyone else is panicking or getting greedy. It's the difference between successful investing and random gambling. That's mistake number 8, not having a plan. Avoid it by creating a written investment strategy and following it consistently. All right, let me recap these 8 mistakes because avoiding them will save you hundreds of thousands of dollars over your investing lifetime. 1. Waiting too long to start. Start immediately, even with small amounts. Time is your most valuable asset. 2. Buying stocks without research. Use index funds or only invest in what you understand after thorough analysis. 3. Trying to time the market. Invest consistently regardless of conditions. Time in the market beats timing the market. 4. Panic selling during crashes. Expect volatility. Don't watch daily. Trust historical recovery patterns. 5. Not diversifying. Own at least 10 to 15 stocks across sectors